Good afternoon. Accounting 230, course number 42139. I thought I would use this day, which is the 2 days, Tuesday before Thursday, Thanksgiving. And of course, we will not have a class on that day. Now, I've already gone through chapter 6, which was on sales and bad debt reserves and contra accounts, things like that. Bank reconciliations, I believe, was in that chapter. And then the following chapter, we dropped down a little bit on the balance sheet. We went into inventory and cost of sales, LIFO, FIFO, specific ID, and average costing. Talked about lower of cost or market. We talked about our new elongated income statement, where you have to compute the cost of goods sold by taking the beginning inventory plus what you purchased. Add those two together, you get the most you could have sold. You can't sell more than you had at the beginning, plus whatever you brought in addition to that. And we call that goods available for sale. And then we learn to take the goods available sale, which is the same for all costing methods, and break that goods available for sale into inventory or cost of goods sold. If we sold it, it would become part of the cost of goods sold. And if we didn't sell it, it would still be sitting in inventory. And obviously, cost of goods available minus ending inventory equals cost of goods sold. Cost of goods available minus cost of goods sold equals ending inventory. And guess what? Cost of goods sold plus ending inventory equals cost of goods available. Cost of goods available is the same for all methods. And I point that out because it's easy to get rattled on a test and get that mixed up with cost of goods sold, okay? Then we went to chapter 8, which I covered last Thursday, and that was about fixed assets and how to come up with the cost to record on the general ledger of a fixed asset, what to do with ancillary type costs coming in when you buy a fixed asset, like insurance and freight. Perhaps you got to revise the machine when it gets into your place, your store, your factory. You might have to knock a wall down to bring it in, which I actually experienced. I told you last week. And then we got into the different depreciation methods, straight line, which you should already know. And then we got into the units of production method, which simply takes the depreciable base. In our book, it was $60,000 for that one problem. And you take the 60,000 and you divide it by the estimated number of miles, say, that asset is going to drive. In other words, you buy a car for $100,000, big fancy car, and you expect it to go for 200,000 miles. Well, your depreciation expense would be 50 cents per actual mile driven. And then the third one was the double declining balance method. Your book doesn't call it double declining balance, but I do. Double declining balance, because that's exactly what it is. It is double whatever the straight line rate would have been, okay? So if you have an asset that would straight line be 1/5, you multiply that by 2, you double it, you get 2/5. How about that? 1/5 is also 20%. 20 times 2 is 40%. And that means you are going to depreciate it at a rate of 40% per year, knowing you'll have a lot of depreciation in the first year and much less in the succeeding years. One other reminder in that chapter, keep in mind the use of the residual value. No matter the method, you can never go down below the residual value. You also never depreciate the residual value in 2 of the 3 methods, okay? You can never go below 2,500. Well, in our book, it happens to be 2,500, so that's on my mind. But you can never go below the residual value on your general ledger. Just, there is a rule, though. Under straight line and units of production method, you subtract the residual value, and that's the number you will depreciate. So with those 2 methods, when you get done, you will automatically end up at the residual value. And you don't mind if I make myself a little more comfortable here? under the method that should be called double declining balance. You, as you put in 40% per year, 40% per year, whatever it might be, you will eventually find yourself depreciating below the residual value. Can't do that. So that last year, when it goes too low, you must adjust so that the net book value at the end of the period is no lower than residual value. Okay, so that's the 10-cent tour through those 3 chapters. Like I said, I've got individual lectures for 6, 7, and 8. And I also posted a review I did with a prior class when they were preparing for the same test that you are, okay? Now what I thought I would do is go over the FSA. You've heard about the FSA. Let's talk about the financial statement analysis. You are going to look at 2 companies in the same market, if you will, 2 companies that are similar in size and similar in their product structure. And I have selected for you General Mills and Kellogg's. These are companies whose products you probably consume every day without even thinking about it. General Mills, they make cereal. Wheaties is a big brand of theirs. Cheerios. They've got all kinds of cereals. And now they've expanded into some snack foods, some health foods, coffees, juices, cakes, things like this. Their competitor is Kellogg's. Kellogg's is best known for their Rice Krispies. They're great, as they used to say on the commercial when I was a little younger, about 10 years ago when I was in college, okay? So they're about the same size. And Kellogg's, just like General Mills, is always branching out into other product lines. But cereal is their main image and their biggest product, okay? So what you're going to do is you are going to prepare an FSA, and I'm going to take you through it a little bit here. The FSA consists of a cover page where you're going to come up with certain numbers, and I'm going to show you that in a moment. But more importantly, you got to give me at least a 3-page write-up on the numbers. And I don't mean simply saying, well, Kellogg sales went up 10% from this year to this year, and General Mills went up only 1%. So General Mills is not doing as good as Kellogg's. Well, that's not wrong, but give me a reason for it. And those reasons can be found in the notes to the financial statements. Another good place to look in the annual report is the president's letter, which usually comes right in the first couple of pages. And the president loves to brag about things they've done successfully. So he may give you a clue as to why sales or profits went up, okay? Another thing you might do is Google something like General Mills announces 2019 earnings or 2018 earnings, something like that. And you'll see whatever the press release was about, and that'll talk about it too. And just general, and then look in the internet just for a couple of newspaper articles to pick up some information, okay? So you need to understand what the numbers are telling us, but more importantly, why. Picture yourself as an advisor to either of these companies and tell them what they did right, what they did wrong, okay? We're not expecting you to write a prospectus that's going to go to Wall Street or anything, but something that would be an indication you understand these items and you're ready to work with them, okay? So let's see if we can share. Come on now, share. Here it is. I trust you can see this Excel spreadsheet, huh? So take a look at this thing. This here is this is your first page. This is your first page. And the title of the financial statement analysis we're about to do is called Time Series Analysis and Component Percentage Analysis. Let's start with the percentage. Let's start with the component percentages, okay? Now, I just made these numbers up. These are just made up. Fat Racks Factory, big building back where I grew up in Newark, huh? Where do we get these numbers? Well, let's look. You're going to do what I just did. I just Googled the hold on here, General Mills annual report. And voila, there's their annual report. Okay, you see the happy child nibbling on some cereal, or looks like maybe animal crackers or something like that. So on our report, we're going to do years 19, 18, and 17, 17, 18, 19. The reason is Kellogg's is on a slightly different fiscal year. And as long as we pick a 12-month period, we're going to be pretty much in line with what's been going on. So start by opening up 2019. And here you go. You got all kinds of stuff. Proxy statement, huh? 10K. Well, let's see what we have here. Let's look at the proxy statement. I just want to see what this looks like, but it's the 10K that, all right, let's see what we have here. Here you go. Here's the letter from the president. And this guy's making a few points, blah, 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 blah. So you might see something up here. Wow, look at this. They're stepping up their growth rate on snack bars, Haagen-Dazs ice cream. Boy, I love that Haagen-Dazs ice cream. Okay, so you get a few ideas here for your essay, and then you get some more things. Okay, so that is one possible source, okay, to get a little bit of information. But to get the numbers, I said to get the numbers, you want to go to the 10K, all right? The 10K is the annual report, and I trust you can see that, the 10K. Form 10K, look at the size of this thing. It goes on and on and on, and there's more information here than you could ever want to read, okay? So we're targeting certain areas, okay? If we go back to our spreadsheet, which I will in a moment, we are interested in the following. We want the net sales of General Mills. We want the cost of goods sold. That will give us the gross margin. Because as you know, net sales minus cost of goods sold gives us gross margin. And I think you just need to pick the number called sales. These companies this big sell to gigantic wholesalers. These are people even bigger than Walmart, who then distribute to Walmart. My point being, they should not have much exposure in terms of sales returns, sales discounts. In fact, you're going to read that one of these companies eliminated the 210 net 30 sales discount they were given. Isn't that interesting? They went to their big customers and they said, hey, we just figured out, because we took accounting 230 with, at SBCC, and we found out that 2% we're giving you every 10 days is the same thing as about 37%, right? We saw that in chapter 6. So they said to their major customers, not doing that anymore, pal. And so the major customers said, well, there's got to be a quid pro quo. What are you going to do for us? And General Mills gave them something that they liked. They said, instead of giving you 30 days to pay, you can pay in 45 or maybe even a little longer. So hopefully that was a win-win for both Kellogg's and their customers, okay? And that's the type of thing you can glean out of this, okay? Table of contents. Okay, let's see if we can find the financial stuff. Wow, it looks like it's way down here. But financial statements and supplementary data, you see that right there? Item 8 on page 50. So let's go down to page 50. Page 50. Come on out, page 50. Okay, we're getting close. Look at all this information before we get to page 50, huh? Page 50. Page 50. You see this letter here? The management of General Mills is responsible for fairness and accuracy. That, of course, is a question I put on everybody's test. Who is responsible for the integrity of the financial statement? It is not the auditors. It is not the tax people. It is the management team. So they write this boilerplate. We're responsible for the fairness of these things. The statements have been prepared according with accounting principles. Management has adequate controls. Very interesting short thing to read. And the auditors for this company are KMPG. And that's a big one. That's one that came out of the mergers of Pete Marwick and some others. I can't recall what KPMG stands for, but it's four of what used to be called the Big Eight accounting firms, many of whom went to pot in the Enron scandal. Okay, so that gets us started. So what are we interested in terms of the FSA? Well, you got the letter here from the president, and this is kind of interesting. This is the report from the auditors, and the auditors are saying that we have audited the accompanying statements, all the statements in the 3 year, and we have also audited this. In our opinion, the consolidated financial statements referred to above present fairly in all respects the financial position of the company at the end of these years and the results of its operations and cash flow. Also, in our opinion, the company maintained in all material respects effective internal controls over financial reporting based on criteria established in internal control and integrated framework issued by the Committee of Sponsoring Organization of the Treadway Commission. I'm sure we've all read that, huh? The point is, some of this language is new, as is some of the language up here in the president's letter. About 20 years ago, there was a company called Enron. I hope I'm not repeating myself, but long story short, Enron was a company that was manufacturing nothing but phony numbers, and they even paid off the auditors. So when the auditors are in on the scam, it's really impossible to detect. And it was only blown up after a young woman named Bethany McLean, a financial writer for Fortune magazine, CPA, she went to Enron to interview the chief financial officer. And it was supposed to be a puff piece. She expected to come back to her desk and say, oh, what a great company. Instead, she wrote an article, How Does Enron Make Its Money? Anyway, it turned out they were making no money. They were cheating people. They went bankrupt. Their employees, all of whom could only have Enron stock in their 401k, lost everything. So if you worked there for 40 years, like some people did, and maybe you were a blue-collar person and you were maybe earning $10, $20 an hour most of those years, you could have saved a lot of money, but lost it all at the end, okay? And these extra verb words you see here all are due to that Enron scandal and a ruling that came, a new law that was passed called the Sarbanes-Oxley Act. Remember that from chapter 1? This is the result of that, okay? And you might be interested in noticing that General Mills is headquartered in Minneapolis, Minnesota. It's a big grower of wheat and corn and oats for their cereal, okay? They're a Midwestern company. So now that we got the blather done from the president of the company, here, let's take a look at your consolidated statement of earnings. Now, we could have found this information above somewhere, but this is in the most clear, easy to digest form. So take a look. Wow, General Mills actually uses the word net sales. There's net sales. That is the first line of your FSA for the years 19, 18, 17. Well, here's your cost of goods sold. So they're giving you that. So your gross margin is going to be the difference between these two numbers. So these guys have a gross margin about 5,000,007, whatever. And they're giving you the operating profit. We're not going any lower than operating profit. So plug the operating profit in, and then the difference will be your gross margin less the operating profit. Can't be much easier than that, huh, guys? It's right there for you, okay? So now you know where to go for some of the information. Now, let me go on and tell you, now that was the income statement, consolidated short income statement, okay? And they earned dividends of They earned so much per share. They earned 282, 369. Take a look at some of these differences here, huh? The earnings have gone, the sales have gone from 56, 15, 7, 50. They're really not growing very much, huh? It looks like their costs are going up at a much bigger clip, and so are their expenses. So their profit here for 17 was 2,492,000. They had higher sales, but lower operating profit here. And then they had actually a fairly good boost from 18 to 19 and higher income. We want to comment on that. So that takes care of much of the front page. And we're going to go into that right now. Right now. Okay. You know where to get the information. You know where to get the information now. Don't be yellow. Chicken out. You get the information for here. Okay. What I highlighted in yellow is the set of columns that you are going to fill in just by going to the annual report of each company. So you're going to go to General Mills first or Kellogg's, and you're going to do one company on top and one on the bottom. And I want this portion of the front page to look exactly like this, okay? And then you are going to drop your numbers in. Now, let's talk about the component percentages. When we say component percentages, we mean a component of sales. Component of sales. Net sales by definition is 100%. Cost of goods sold is this number here. That gives us this number. Well, how did we get 39.7? We got it by dividing 36354 over the 100%. 36354 divided by 91578 equals 39.7%. Now make sure you add that one decimal point exactly like that. That's important. I noticed it wasn't done here, so whoever did this is going to get a slap on the knuckles, okay? Oh, it's formatted a little differently. I'm not going to worry about that now. But we want that extra decimal, that one decimal point, okay? So if net sales are 100% and cost of goods sold at 39.7%, 100 minus that better equals 60.8, what is that, 60.3%, and 55,224 divided by 91578 better equal 23. 60 minus 23, 36.4. Therefore, 21,873 divided by that. That's not so hard now that you've seen how to do it. The component percentages represent a component of sales, okay? So that's the component percentage piece. Gives you a lot to look at. Let's pretend these are real companies. Oh, I got the same numbers for each of them. On this analysis, you would say something like, these companies are amazingly similar. I've never seen anything like it, okay? But you'll see differences. You know, maybe this guy here, his number is 42%. We'll just plug a number in there. 42% for cost of goods sold. This one's only 39. That might be worth a comment. That seems like a big difference, about 10%, huh? So component percentages. Let's go to the second part called time series. Time series. When we say time series, now we're comparing year to year, okay? We're comparing year to year, and we want to see what the year-to-year difference is in dollars and as a percent, okay? So since we are working with 2019, 2018, 2017, these numbers would change accordingly, okay? This would be 2000 versus 2018. And this would be 2008. Do it the easy way, huh? 2008 minus versus 2017. 17. I said 08, I meant 18. 17. All right, there we go. Little Sheldon Cooper, if you ever saw The Big Bang Theory. I have to get this thing lined up the way I like, okay? So what are we talking about? Hint, always start with the current year. Always, always, always. Current year minus prior year, 91578 minus 79871 equals 11707, okay? That's how we got that 11707. And we do that with all of these, 36354 minus 3500. You will get that, and then you will get percentages. Now, these percentages don't add down to 100. That's not what we're talking about. We're comparing different numbers, changing at different percentages. So each one of these is independent of each other, okay? So don't knock yourself out thinking you have to add these down. You're not going to add the percentages down. The dollars have to come out right, but not the percent, okay? And then we go to the next set of years. Again, you start with the earliest year, 797871 minus 77332 equals 2539. Now, the important part, since these are big companies, dollar differences may not show the picture as well as percentages do. So now we want to know the percentage difference. And the percentage difference, starting with the beginning of the year compared to this year, is 14.7%, okay? Different ways to do that calculation, but may I suggest this method? Plus, and put it into parentheses, plus, let me move it up a line here, sorry, put it on the right line. Plus, put it into parentheses, 91578 divided by the next year, 79871, close the parentheses, minus 1. And if there's a God in heaven, I'll come back to that 14.7%. There it is. This is a decimal, so you have to move the decimal point over 2. Okay? So that's how I like to do it. And here it is. You can, I don't know if you can see it up here in the results bar here. Prior year, put this in parentheses, prior year divided by current year, put that in parentheses, minus 1. Okay? If you don't do the minus 1, you're going to get a number that looks like 0.853. And then you're going to have to subtract that from 100. So it's the same thing. Okay? So now we've done this portion of the page. Now there's a part that's not here, and I want to go see if I can find the other piece, okay? So give me just a moment here, and you can take a break. You can catch up on your studying for a few minutes while I go through this, hopefully fairly quick. Come on now. Hey, you want to talk a little sports while I'm looking for this? We got our sports fans here, right? My New York Jets are 0-10 in the NFL. They are literally on track to be the worst team in the history of football. Two other teams have gone winless in a season, the Cleveland Browns and the Detroit Lions, and they did it fairly recently. But both of those teams scored a lot more points per game, and they gave up fewer points per game than the Jets are, so they could be the world's worst. Okay, I'm getting there, guys. Please forgive me for not having this ready. And I will find this here. I'm now where I need to be. And hopefully I can copy this over. Okay. If I can't copy this over, we'll do it together here. Okay, I think I have it. Let's hope this copies. Copy. we will go back to our sheet here. Or maybe I'll put it on another sheet. Just, I don't want to foul this one up, okay? Put it on another sheet right here. Well, it didn't work. So let me show you what we're doing. We're going to do this together, okay? I'm so sorry. So this is a 4-part FSA. The next part is we're going to do the inventory. Hold on again, class. Bear with your teacher here. You got nowhere to go, right? Plus, this is on tape. You can always pick it up later. So just hold on here. I'm so sorry to slow us down a bit. We'll get there. We will get there. I love a Cecil. Boy, this makes me. We're getting there. Okay, I found something that'll make this easier, okay? This is the rest. Hold on, I didn't give you the red. Yeah, we can look at this. Can you all see this here? I'm gonna just double check, new share. New share. Okay, this is from a student of mine, and these are different numbers. This was a couple of years ago. Numbers might be different. Here, you're going to see, you're going to give me the AR turnover, and you are going to give me the credit sales divided by receivables, get the receivables turnover, divided into a year to get the days. I'm not going to go any slower than that. I want to get out of here for a reason. And just give me one more second. One more second. I bet you can guess. I bet you could guess. Let me share this. Share. You may see it already. Okay. This is from a student of mine from a couple of years ago. And this is an acceptable piece. You want these items to be laid out pretty much like this. It's up to you. I'll give you some other examples, but you are going to go to the annual reports again. You already have the net sales. Now you have to get the average receivables and the average inventory for each company, divide it out to get the turnover, divide that turnover into 360 days. And this company has a days of sales of 33. This guy's got 53. Sales divided by the average receivable will yield the average time in days it takes us to collect our money. So this company, whoever it is, when they bill their customers, they get paid in 33 days. This company only gets paid in 53 days. So this is in chapters 6 and 7 in your book. You will be tested on this, I'm pretty sure. I didn't make the test up, but I'm pretty sure they're going to give you some multiple choice problems. We're going to need to do this kind of calculation. So finally, let me take you back to the annual report. I said, let's go back to the annual report here. The annual report. And we'll get there real quick. This time I'm going to bring up Kellogg's. I don't think they have the same commercials as when I was a kid, huh? You know, Wheaties were great. For heaven's sake, this thing is disrespecting me. The internet is disrespecting me. Annual report, Kellogg's. Annual report, Kellogg's. Okay. Here we go, new share. Okay, here's Kellogg's. And again, we're using 19, 18, and 17, which means if you open up 19, you'll have all 3 years, because these companies, I think, are pretty much required to look at a 3-year window. So here's their 10K. This is the annual report required by the SEC. This goes to the SEC and investors and tax people and lawyers. Anybody interested in this company for any reason combs through this report, combs through it. And just like General Mills, they're going to have this information here. And here we start to see some notes, okay? Read about the company. Tell me just a little bit. I don't want you to write more than, paragraph or so. But tell me, Kellogg's, their main products are Kellogg's, Cheez-Its, Pringles. Whoa, great stuff. Eggos. So you got an idea what Kellogg's does, huh? And you could read through this like crazy, but I'm not asking you to do that. Let's see if we can find the financial statements. Now on Kellogg's, they come much more quickly, like page 23 or something like that. So let me roll this down till we see some numbers. 16, we're getting there. You yell when you see something that looks like numbers, okay? Because I can't see it that well. Oh, I think we're there. Okay. Well, here is where they present it one way. Again, this is not their financial statement. This is just selected data. But just from page 25, you can get that information. So let's take a look at it. Page 25. Net sales. Oh my goodness, they don't give you the cost of goods sold. What do? We do this. Net sales times the gross profit is 0.323. That'll give you a number. It'll give you a number, whatever, 3 times about $5,000. And you then subtract that number from here. So there's your net sales. There's your gross profit. Your cost of goods sold is going to be 13,578 minus 32.3%. Now all you need to do is go down to the operating profit line, put that at the bottom of your template, and there's what we need to subtract out, okay? So again, I showed you where to get that information. Now we also have to do the turnover. The turnover of receivables, the turnover of inventory. And I was hoping to see, all right, let's see if I can't find it right away, what I'm going to tell you is you got to find their balance sheet here. Unfortunately, they don't show that to us too quickly. So give me just a moment here. Look at all of this lovely information. Oh my goodness. All of this stuff. So let me just keep going down. Big notes on their liquidity. That's interesting. Liquidity, working capital, you might think of it that way. Uh-oh, I think I saw it, ladies and gentlemen. Notes to the financial statements. Well, when you see the notes, you've gone past the financial statements, okay? Now, here are the exact financial statements. If you don't want to bother doing the multiplication. Here it is on page 54. There's your information. For those of you who don't want to multiply 13578 times 0.323 to get 2980, okay? Whatever that number was. So here's your net sales. Here's your cost of goods sold. Subtract them to get the gross margin, and then subtract the operating expenses. So there it is, nice and neat. Now, on both sets of financial statements, we're going to have to go to the balance sheet. Well, that's not a balance sheet. The balance sheet should follow here, huh? And here it is, huh? What are your average receivables? You take 2019, 815.76 plus 1375, add them up, divide by 2, that's your average. You divide those receivables into your sales, and you will get the number of days it takes for Kellogg's to collect their money. Well, we need the inventories, right, to do the cost of goods sold. You are going to take the average inventory here and divide that into the cost of goods sold to get the number of days it takes Kellogg's to sell their product. In other words, from the time they purchase a product, possibly for resale, or perhaps they are packaging their own cereal, from the moment that cereal is produced and done, off it goes in so many days. And then later on another FSA, you're going to do the same thing with accounts payable. You'll average accounts payable and divide that into cost of goods sold to get the days of payables, okay? So I think that was a bit enough on the FSA. I'll let you go now. I wish you all a very safe, happy Thanksgiving. These are not easy times for anybody. On the horizon is a change in Washington, D.C., new president, for better or worse, hopefully better. And 3 or 4 very promising vaccines coming down the road. But a vaccine is not a cure, and we still have to, practice safe distancing and wearing masks and all these basic courtesies to be part of America, to pull together as a country. But as those vaccines come on the market, that'll make a bit of a difference. But it's going to be a while. It's not going to take 6 months. I have a feeling we're looking, I hate to think, maybe another year like this. God, I hope not. I hope I'm wrong. I hope somebody's looking at me and saying, Bob, you don't know what you're talking about. We'll be out of the woods much sooner than that, and I hope so. Anyway, take care, guys. You be good.